Defaults are rising, the condo market is plummeting, and consumer confidence has never been lower. If you haven't been seeing the red flags, what I'm going to tell you in the next few minutes might shock you. But rest assured, I'm either going to show you how you can mitigate your risk or possibly capitalize on the opportunity of a lifetime. Let's start with the numbers. The Canadian Bankers Association, also known as the CBA, reports that just over 11,000 mortgages nationally have gone into arrears by 90 days. That's 0.22% of all mortgages across Canada. That's up from 0.14% last year, a 57% increase. Now, even RBC is raising their alarms, saying that their mortgages are up from 0.19% last year to 0.3% this year. It's a 50% increase. So the bottom line is that historical defaults are still relatively low, but it's the speed at which they're increasing that is pretty concerning. It just shows that a lot of borrowers are getting into financial trouble very quickly. So here's the hidden trigger: mortgage renewals. Over 60% of all the mortgages across Canada are coming up for maturity in 2026. That means they're coming up for renewal. Now, out of these mortgages, over 50% of them are expected to see significant payment increases from when they were originated. And that's because a lot of these mortgages were originated in ultra low rate eras. So the 2%. People thought that they were locking in within their comfort zone, but they're actually about to feel the big hit. Now, thankfully, we have the stress test, because out of all of these mortgages, over 90% are going to renew under what they were stress tested for: prospective affordability. Now, that doesn't mean that it's not going to be painful, because over the last few years, consumer debt has also increased and consumer cash flow here in Canada has decreased, the discretionary income. Now, if you're already feeling the pinch, maybe you've assumed some more debt, your employment income has not kept in line with the increase of the cost of living here in Canada, get ready to feel the pretty big squeeze. Now, let's shift to condos, arguably the weakest point in the entire market. In Vancouver alone, there are over 2,500 condos that are completed but just sitting there. Developers are delaying and even canceling projects because pre-sales just aren't happening. And for some developers that are choosing to complete, they're turning their condos into apartments because, again, the condos just aren't selling. The virus of the condo crash is spreading. Defaults are bringing down values, and foreclosures are creating new low comparables that are bringing down entire neighborhoods. And the worst hit: condos under 550 square feet. Many can't even be rented for the cost that's needed to maintain them. That's the mortgage, condo fees, utilities, and many can't even be sold or flipped because the value just isn't there. If you own a condo or have exposure via an investment or a portfolio, unfortunately, you're in the red zone and you need to hold tight. You'd think with rates coming down, buyers would be more keen to jump into the market, but sentiment is frozen. In August of 2025 this year, home prices across Canada dropped just over 3.5%. And in the condo specifically, it was over 5.3%. So even when the market shows improvement, rates have come down, prices have come down, there is still hesitation. The consumer confidence isn't there, and people aren't ready to get aggressive yet. Many buyers are still waiting on the sidelines, possibly looking for a deeper discount, or maybe afraid that prices are going to slide even further. Now, a really interesting fact is that many new homeowners are increasingly choosing the variable rate mortgage over the fixed rate. Since February of this year, it's been 42% of all mortgages originated are going into variable rates, meaning that they are going to be exposed to the rates dropping, being able to capitalize on the rates going down. So you might be asking yourself, who is in the danger zone? Well, let's go through the list. Firstly, it's going to be homeowners that have a mortgage coming up for renewal in the near future. Let's call it the next year and a half. Next, it's going to be condo owners, but specifically condos that are a little bit smaller, 550 square feet or less, or maybe your condo's just in an overall weak location. And those people with tighter budgets, maybe weaker income and high leveraged. If you assumed a lot of debt since the last time you did your mortgage, that's definitely a concern. Maybe you just got laid off, or possibly your union's on strike. And lastly, it's going to be investors that invested into the condo market or overall leveraged to the nines. They might not have a cushion if things go south. Now we know what we need to look out for in the market in the coming months, and we also know who might find themselves in hot water. Let me give you some actionable steps you can take right now to make sure you find yourself in the best situation possible. Firstly, don't be passive. If you've got a mortgage coming up for renewal, talk to a broker like myself so we can start to run a renewal scenario. We'll see where you are right now compared to where you need to be come to your mortgage renewal. If things need to change, shift, or some action needs to be taken, we can help provide that 100% clarity on what needs to be done. Now, this is only going to apply to those people that have mortgages coming up for renewal in the next 4 months, but lock in a rate. If you lock in a rate and rates come down, you can get that lower rate. But if you don't lock in a rate and rates come up, you're going to be subject to whatever the market yields when you want to lock in that rate. Reduce debt and free up cash flow. With a lot of mortgages coming up for renewal in the next year and a half, I've been seeing a lot of Canadians roll their debt into their mortgage. Now, what this can do is it can drastically increase cash flow. So what you're doing is you're consolidating high interest debt into a low interest mortgage, which is amortized for 25 to 30 years. Now, this might seem obvious at this point in the video, but avoid buying tiny condos right now. Especially be cautious of buying them in underperforming locations. Wait till the market shakes out, and I'm sure you'll be able to get a great deal on a condo compared to where prices are right this moment. Now, get advice from a mortgage professional tailored to BC or your region specifically. BC and Ontario right now are performing very differently than call it Saskatchewan, Alberta, and Manitoba. You want to make sure that you understand your market specifically. If you own an investment in real estate, review your rental income, analyze your cash flow, and the overall vacancy risk that you have in your area. See about mitigating your risk at every opportunity. And lastly, monitor your equity. If your home value declines, that could put your home equity lines of credit at risk or possibly future opportunities to consolidate high interest debt. Here's my final warning. The cracks are already forming. Defaults, they're not alarming yet, but with the wave of renewals incoming and the condo pressure here and now, it might start to accelerate everything. If you wait until everybody's panicking, your options are certainly going to narrow. Brokers like me can provide clarity, 100% clarity on your situation. So drop a comment. Tell me which part concerns you the most. Is it the condos? Is it the defaults? Is it the renewals? I'll respond. And if you want a roadmap to see exactly where the risks lie in your situation, click the link below. Don't wait until it's too late. My name's Daniel Titorenko, and don't be a statistic.